Alrighty, thank you. I appreciate you guys and Woody and I to be on this webinar. We have a lot to go over, so let's get started. It basically in the stock market, the main thing that any service or person wants is to make better trading decisions. And the key to making money is putting the odds on your side. And sentiment timing allows traders or investors to be proactive instead of reactive to market reversals, because you're going to be able to anticipate them in advance. And that comes from Woody Dorsey, who's been doing this for over 35 years. He's been working with some of the largest financial institutions in the world, and he's one of the best market timers in the world. So there's no software or person that's going to be 100% correct all the time. So as much as Woody is one of the best in the world, nobody's going to be right 100% of the time. But the markets can be predicted, especially in the short term, with a high degree of accuracy. There's a code that it follows, but it's always changing, and that's what Woody has mastered throughout his 35 years of market timing. And the main thing that we do at Sentiment Timing is we let people know, is it safe to be buying? Should you be selling or shorting, covering shorts, or just keep a neutral view? And a lot of that comes through Woody's sentiment data that he gets, because there's been this, there's a quote, it's, when too many people jump on one side of the boat's going to tip. The same thing goes with sentiment and the stock market, and that's what Woody tracks on it. So what we do, we are one of sentiment timing is one of a handful of services that actually tracks investor sentiment. Woody is considered by many as one of the pioneers of investor sentiment and market psychology. His technical timing profiles are what allows our members to anticipate market reversals, because he predicts these sometimes weeks in advance, and I mean, I've seen him do it months in advance. And from that, what we do is we combine technical analysis with the investor sentiment and the technical timing profiles to try to figure out where the S&P is going to reverse. So we diagnose the S&P 500 through investor sentiment, technical timing reversal dates, and just regular technical analysis on a swing trading short-term basis that typically lasts between 2 and 6 weeks. So as I said, Woody's has been doing this for 35 years for some of the largest financial institutions in the world. He's been on just about every major financial news station, and the USA Today actually quoted him as the stock shrink. And Woody's been doing it for 35 years. He's the best-selling author of Behavioral Trading and one of the pioneers of tracking investor sentiment. He's worked with some of the largest financial institutions in the world, and he is considered by many on Wall Street as being one of the best market timers in the world. So with what we do at Sentiment Timing, what we believe in it, in the whole philosophy of how we kind of let our subscribers know what's going on, is that human beings in the markets are irrational, and there's always going to be an irrational element at work. And that is what creates your market opportunities. Now, Woody has a proprietary database of stock market sentiment that is collected through daily polling, and effectively it filters thousands of sentiment sources, and sentiment extremes will always be seen at market reversals. So our market timing matrix is time, and that's when Woody's going to be, when he lets people know when to expect a reversal date. And like I said, it's usually weeks, and sometimes I've seen it a month in advance. Sentiment is how traders feel about the current trend, and if he's expecting a reversal and the market is going up, and we see sentiment that is at bullish extremes, what we do is we start looking at the price and seeing is there any divergences on the regular technical analysis, and where the S&P be reversing, and the same thing, it's vice versa if it's going down. So let me just see something real quick here. Okay, so with this, Woody, are you able to? Can you talk on this right now? I'm not. I know he was having some issues before, so I'm not. I don't think they changed Renee. I'm not sure if you changed him over to a presenter.
Okay, he's on now. Sorry about
Oh,
that.
okay. All right. Woody, can you hear me? Hang on. He might be on mute actually. Well, let's do this. He said we're just going back and forth on Skype on this, and he's saying he's not able to talk. Should he unmute something or? Hang on one second, folks. We're just trying to figure this out here. Okay, you know what? Let's do this. I'm not sure if Woody can join us, then he'll be able to come on and talk. But I can walk us through everything that is going on right now with where we are. So, what is sentiment? And sentiment is basically how investors feel about the stock market. Most technical indicators are derived by price, and sentiment is a measure of human emotions about the stock market. So extreme sentiment doesn't always mean that price has to reverse at if there's an extreme bullish or bearish sentiment. It's a key indicator, but it's not a determinant. Sentiment always has to be interpreted along with price. Now, tracking both intermediate and shorter term sentiment offers a clearer view of when price reversal may be near. Woody's been collecting this data for over 40 years, and it shouldn't be confused with any other sentiment data because there's not really anybody out there that's been doing this, collecting this data for as long as he has. And as I mentioned before, it's he gets his data through data polling, and each one it's basically goes through all these processes to go into his database, and from that we come up with our sentiment measures that are that are in place that we show everybody.
Can you hear me?
Oh, I can hear you now, Woody. Okay, there you go. I wasn't sure if I was gonna have to run this part by myself on it.
You know how to do it anyway.
Yeah. All right, I'm gonna go back. This is Woody Dorsey, everybody. I'm glad he was able to make it, and I'm gonna leave you with what is the sentiment, and you can take it over from there.
Yeah. Well, sentiment is the missing link in market interpretation. It's a way of measuring psychology in the market, which is a critical element. So I've been studying it for a long time, and we'll show you some examples of how we use it both in a very micro sense and in a larger sense. Suffice it to say that I have this polling process and this, as a result, this database of sentiment. But data is not as important as knowledge and interpretation. So you see here, for instance, he's showing that we had around September 13th on either side of it a 1% bullish and a 4% bullish in the market. Along with our other timing modality, which had suggested we might make a low around September 13th, we had the low sentiment. We suggested that people cover their shorts, which we had on for about 20 trading sessions. That's how you can use specifically sentiment along with timing. We had 5% bullish this morning. We got short last Friday with 5% bullish today. It makes sense for the market to bounce. That's what it's doing. So there's a lot to this, and in this service you get to see not just, oh, people are bullish or they're kind of bearish or I don't know what it means or the moving average, this, that, but the specific sentiment. Let's look at some more stuff.
Alrighty. So this is the intermediate term sentiment. So Woody tracks it on both the short term and the intermediate term. And you want to just go over this part, Woody?
Yeah, I don't see the slide here, but in other words, I look at the daily sentiment for an individual day, which is very telling. Then you see here on this slide a little bit longer term measure of sentiment. And I look at even longer term measures of sentiment as well. But the focus with this product is to give traders an insight, and again, into the next week or 2 or 3 or 4 or 5, not, what's the market going to do 5 years from now.
Hey,
So
Woody, one question that I wanted to ask, because I know it's been brought up a lot, is do you use your sentiment data as a divergence to if the market is moving higher and say your intermediate term sentiment is moving lower? Is that considered a divergence in your eyes, or is that it doesn't really mean anything?
no, it does. It does mean something. I mean, it's just the same thing when you look at a price chart and you see MACD or relative strength or reversal days. It all means something. But again, it's also in the interpretation. But one of the things here, and you and I discussed this in the report, is that when the market got incredibly sideways at the top this summer, the sentiment was diverging badly. As you see here, and that was a tell that there was likely going to be some kind of a break to the downside, some kind of trap door would open. So yes, divergence is important, but every market phase is slightly different, and you always have to be interpreting it.
One other thing I wanted to just show you, because we went over how you're going to get sentiment extremes at reversal points. And if you notice, when we were going sideways, like Woody was just talking about, we had a series of bullish sentiment. So everybody was anticipating the market going up, and it came right on his turn date, which we'll go over in a little while. But you can tell that all these traders up in this area got trapped on this big move. Once they panicked and covered, we started seeing the low sentiment readings, and from there we saw a pretty nice rally from that. So I just wanted to point that out, Woody. Okay, so the next part that I have on here is your technical timing profiles. Do you want to just let everybody know how they work, and then we're going to show some examples of calls that you've made in the past, and just even the most recent call.
Right. So market timing is critical. And again, I've studied it really for 40 years, and I've gotten into the little nuances and micro tells in timing, which are incredibly important if you're a trader. And there are many aspects to it, and as well as there are many time frames as well. And obviously, I can't go into everything in a limited period of time, but some of the things I look at, which are all different things. Here, Gary's referring it to as a reversal date or a turn date. I think of it more as that I have a sense going from the study that I do of when prior lows or highs happened about when there might be a low. So for instance, a month ago, I had this idea that there might be a low around September 13th. Now, that was not necessarily a reversal date in that it could have been a high or a low. It was due to be a low. So sometimes you will have a date which is, hey, this date is really important, but often you can tell if it's going to be a high or low, and then it becomes a question of what degree is it going to be. Now, the second thing, what I call the attention spans or trend durations, is something that I invented a long time ago, which is basically, instead of looking at cyclical phenomena, let's say, like sell in May and go away, for instance, is the idea that a rally or a decline in a market may last certain typical amounts of time. So in a very micro sense, in a fractal sense, let's say that during any given day you might have a rally. It may last 6 hours, okay? But for our purposes, if you look at things like a rally lasting 5 days or 20 days or 3 months, those are important things to look at. So one of the things I mentioned here is that the nominal high in the stock market was, depending on how you look at it, August 13th or August 15th. And what was interesting is that was a period that I had in mind, and we had 97% bullish there, which again ratified it. So at any rate, the market tops there and begins to go down. So then we would say, well, what is the typical trend duration? So what I pointed out here is that one of the typical ones would be a 1 month period of time, or 20 trading days. That's what we just had into the low. But I have to overlay all these different timing technologies as well as different scales of time. And we see that sometimes there's a code that develops where this has just happened. I'll tell you about this. Is where you see, for instance, okay, the market is going up for 5 days, going down for 5 days, and then something happens, and then it changes its code where it goes up for 9 days and down for 9 days, etc. So you constantly have to be watching. It's like the weather. And by doing this, I derive what I call the timing narrative or market profiles. So one of the things after covering around September 13th, because we had the trade up that lasted a certain amount of time into last Thursday, Friday, with some high sentiment, gave a sell signal that I wasn't sure how big it was going to be, how long it was going to last. It was a nice trade. But the market, having done that, now has set up a kind of resonance of timing factors for around October 19th, which I didn't have. That code was not available, let's say, 3 weeks ago, but now it is. So that becomes an important new market code. And obviously, we'll see when we get there, and we'll see with the sentiment, whatever. My thinking is that we're probably in some kind of compound decline. There could be down, up, down, up, down into there, but there's no like, okay, market is really simple. It's going to bottom at the election. It's going to bottom on November 8th. Let's put that trade on now. It's not that simple. You really have to keep studying it. Okay.
Alrighty. So what I wanted to do actually is show you the what he was just talking about with the actual. This is the most recent call, and this was the going to the August 9th, where he was saying that we're supposed to be looking for some weakness that was going to play out after August 12th, and that is pretty much exactly when the market topped, even though it was taking a little bit of a different turn than what we thought it was going to be doing. It's still topped on that date. So what I want to do is just give you some examples of how these market reversals actually, how they've worked out in the past and stuff like that. So here you can see this is going back to August 4th, 2015. Now, there is what he had said, and this is what we put in our market timing letter, was that there's a potential for a trading target or sell zone due on between 8/14 and in the 21st, and he called it a kill zone. Now, Woody, you have a bunch of different names for either the lows or the highs, and one of them was the kill zone. And what I want to show you is how this works. So this came out on August 4th, and if I just go to the actual chart here, so this was the 4th. This was when we had this is when Woody had called for the top or the kill zone to come into play, and you can see right in this area here was when the S&P had a big drop. And the main thing that we tried to do at Sentiment Timing is it allows you to control your emotions. If a lot of people that were in this area were expecting this market to shoot up, and I remember back then they had targets at 2,200, 2,300, and during that time frame, all of our members knew that there was a kill zone or a drop that was pending that was supposed to start right in this area here. So instead of listening to the the financial news stations who just have people that come on there all the time, and they really have to be bullish on the market because most of them are financial advisors or work for companies like that, and they make money when people are in the market, and they don't want people, so they're going to find every reason to kind of be bullish. And then when you have your newsletters and the ones that are basing it off of Elliott Wave or any type of other technical indicator that's based off of price, they were looking up as well. So you had everybody looking up at this area here, but yet we knew that there was a big drop that was coming. So instead of joining the herd that was looking for this market to head up, you were able to either step out of your long positions, put a stop on your long position, or go short and get a huge move on that end of it there. So this is going back now. We're going to the excuse me, September 3rd, and this is right before. This is when we had the big drop on the 8/21. So on the 3rd here, what Woody had said was that there's volatility that was due around the 17th, and it was separate from the FOMC meeting, but it is looking for downside into the 23rd to the 25th. So again, this was on September 3rd. So your expectations were to look for, if the market was heading higher, on the 17th, that was going to actually, look for the market to head lower. And if you notice on this was the exact 17th. So this was when we had mentioned to expect your weakness to come on the 17th, and it was the exact date, and the market headed down from there. So it was our members and people that were reading Woody were able to control their emotions when this market was heading up. They weren't, jumping on the bandwagon that we were heading up to new highs, because we knew that there was going to be volatility that was set on September 17th, and since the market was heading up, we were looking for the market to reverse down on that, and that's pretty much exactly what happened. So that is how a big part of our service is doing that, is just allowing whether you're an investor or a trader to anticipate moves. And when you anticipate things, you're not going to be surprised, and when you're surprised, that's when you panic, and you make anytime you make a decision that you're emotional on, like you're going to lose all your money or something like that, you're going to make a bad trading decision, and you're either going to be selling at the exact lows, or you're going to be buying or at the exact highs. And that's what the sentiment gives Woody an idea as far as what's going on with things. But here you can see this was a perfect call on that. And so what we want to do, as I'd mentioned before, there's three real aspects to the to our newsletter. You have Woody is the primary that gives the technical timing indicators that we look for, either a low or a high. So we're able to people are able to anticipate when to expect a reversal. Now we also use sentiment that gives us almost confirmation on whether, if we're looking for a reversal to the downside, our expectations would be that we're going to see a series of bullish sentiment readings, and if the market is supposed to be making a low, we're going to start looking for that panic or capitulation and a very bearish sentiment. And from there, what we do is we then move into our technical analysis to try to figure out when and where the market is going to reverse. So I look at support and resistance, and my technical divergences are when you see like Woody was saying, the MACD or the RSI, anything that is going down as the S&P is going up, that's considered a bearish divergence. And if we have a technical timing turn date that's approaching, and we see everybody that is at sentiment extremes that is bullish on the market, we have a pretty good idea that the market is going to reverse, and it's probably going to catch a lot of people by surprise. So and it's vice versa. If we're looking for the low, and you see the technicals that are moving higher as the price is moving lower, it gives you a positive divergence. And again, if we have sentiment that is low, and we also have we're at support and we have a technical turn date, you feel pretty confident that you can start looking for a low in the market. And again, what we do is just try to give some pivots as far as where to look for the S&P to reverse. So this is an example of how I use the technical divergences, and this is going back to to June of actually it is September of 2014, and it was a black hole call that Woody had called actually all the way in August that this was supposed to be pending here. And if you see here, you can see that the S&P is moving up here as the MACD was moving down. So we had a technical divergence that was in place here. We knew that this was the date that we were anticipating the reversal, and we had extreme bullish sentiment readings as well with a divergence, and from there you see exactly what happened. So everybody that was reading us knew that even though we had this big rally here and we made the new high, that it wasn't going to last, and you wanted to anticipate that the market was going to have a big drop. And the black hole, which is the actual low, was set on October 13th. So again, this all started in August when Woody said to expect a weakness from September 20th, and expect the low to come in on October 13th, and that's exactly when we did get that low right there. So let's take a look at another example here. And this is what I was just showing you, the most recent call. And what we were looking for was stocks always had a probability of a harsh downturn next week. So this was on August 9th that we were anticipating people, letting people know that we're anticipating a drop. And it was supposed to be after the August 12th that we were going to be expecting the weakness to actually pick up. So this is what I'm going over with the time aspect of things. It was right anytime, and we were saying this from the end of July to expect the weakness to come in on around that August 12th time period. So we knew the time that to anticipate this reversal. And now if we take a look at the sentiment, notice all these sentiment readings up here. Everybody was bullish on this market, but this is what Woody was saying, where it has to, just a high sentiment reading or high bullish sentiment reading doesn't mean that the market is going to reverse to the downside. Sometimes it confirms that a low is in. So you can see that we had the 1% and 3% bullish readings here. So everybody was bearish on the market as we were coming down. And then when we came up, we got bullish readings here, and that was confirmation that this low is in place. But once you started seeing all of these, everybody jumping on the bandwagon and everybody looking at the 2250 or 2300, we saw the sentiment moving average that was diverging from what the price was doing, which was going sideways. So we had the time that was supposed to be the August, after August 12th. We have the Y, and that's the sentiment extremes that we have on that. And now if I take a look at the regular chart here, you can see that we had a massive bearish divergence in place as the S&P was moving higher, and this was actually the 15th was the exact top, and from there we had a drop on that. So that's pretty much how we how everything works as far as with our service. And Woody, do you have anything else that you want to add on this?
No, I think you've done a good job in explicating that it's a combination of the sentiment, which we have a unique understanding, history, polling, and experience with, and the timing within the timing. In other words, I'm able to parse out time in a very defined way. Not the market may go up or down for 3 months, but that specific timing. And the timing and the sentiment go together. And then you overlay as well the technicals. So these three factors come into play, and we're very subtle with understanding in order to give clients the sense of where they might want to put on risk where they want to take off risk, and what they might expect. And that is extremely useful, and it is unusual because no one else can do this if you are trading.
Well, one other thing that was that I want to bring up on this was that we were looking for the weakness to come in on August 15th. The low that Woody was that it's been in our reports for the last month was September 13th. So it actually, we did, the high was pretty much predicted, the low was predicted, even though we didn't really have everything in line with the technical divergences. We did have we had sentiment that hit it hit a very low extreme when we upped. I'm not sure which one that is here. Well, I'm missing. This is an older one on this, but we had a low sentiment extreme when we made that low, and it came in on the actual the date that Woody was looking for the low to be made. And from there, that's where we said that, we kind of recommended to take some shorts off the table, or put a stop in place, or just don't really press the short side. And as you saw what has taken place since that, we've had a really nice rally. So it worked. It's worked out pretty well. And that's really what when you're able to control your emotions when you're anticipating when the next date is coming for the trend to change. And you see that you have sentiment that is that's supporting that, and then you have technical analysis that's actually telling you where to look for a low or a high. It's it's three aspects of the market that, like what he said, nobody else in the world can do this, because nobody has the same data or information that Woody has, and he's been doing it for over 45 years, for over 40 years, and has been working with some of the largest financial institutions in the world. So what we want to do is we want to open up the room. If you guys have any questions that you want to ask Woody, we'll be more than happy to answer them. I'm hoping that I'm able to see him on this. But does anybody have any questions that you'd like to ask Woody? I'm going to go here on it. Alrighty. Well, that's pretty much what we have, overall with our presentation. And really, the biggest thing it's being able to control your emotions, and I think that's the most important aspect. Whether you're a day trader, a swing trader, or you're an investor, you have to be able to anticipate when things are going to reverse, because if you don't, then you're going to be trading on emotions, and when that happens, you make decisions that are going to be wrong 95% of the time. So what we're doing for people that are on this webinar, and this is something we've never offered before, we normally just do monthly specials that are a lot more than this, but we're giving only 20 subscribers on this an opportunity to see some of Woody's calls, when to expect the next reversal date, and what sentiment is doing, and how that's matching up with our technicals. We're doing it. It's $9.99 for 2 weeks, and you're going to get a pretty good idea as far as how things work and how it all plays out. And I just put the link that's for this special, and you can click on it, and it has the coupon code. And it's like I said, it's a one-of-a-kind type report and newsletter and service that we do, because there's not a whole lot of people that actually track sentiment and then give you technical timing dates to expect a trend change. So that's Renee. We actually went a little bit earlier than what we were anticipating on this, than the 45 minutes. Do you want to? I don't think we were anticipating some people having some questions, but.
Yeah, we do have our next presenter. He is all ready, so if you guys are all finished, we can get him started. So
yes, then Woody, you're all set, right?
It looks like you do actually have
I'm fine.
a couple questions.
Okay. Oh, we do have quite. See,
Okay.
I don't see him. That's the problem. Is it in the?
What are the questions?
Yeah,
one of them is, what do you follow other markets and indexes? And then when is the next crash or downturn?
Oh, hang on one second. I'm not sure if I just
Nope.
took us off or not. Woody, are you still there?
I hear you. Can you hear
Okay.
me?
Yeah, we can now. Yeah, I went to click on something to see if I can show something on there. But would
Right.
you want to take that
So,
question?
yeah, I will. Sure. Yeah. So we specifically focus and comment on the S&P 500, which is the broadest index that's followed around the world. Now, obviously, all of the stock indices are going to respond to that as a benchmark. So in lieu of saying, oh, well, EEM did this today and we're doing that, I mean, I look at all of these markets. The DAX is very important to look at, the German stock market, et cetera, many things. But we really focus on this one and comment on the one specific index. And that makes it, I think, a lot simpler and very direct for people. Someone asked about the crash downturn. I'm not sure what that really is. There is not specifically, I don't specifically have a black hole coming in the very near future. So I can't say there is a crash coming or crash downturn. Again, we solve the problem for you of not having to be consumed with the big picture, because in a way there really is no big picture where the market's going to go 5, 8, 10 years from now. However, occasionally I will comment generically, we understand as perhaps you do, that the stock market is in some kind of a topping formation, but you know, it could still make new highs that could last for another few months, or it may churn, or it may break down then bounce back. There's a lot of things that can happen before you would get a really defined crash-like decline. Let's supposing we're in a bear market for the next 3 years. I wouldn't expect to crash now. You expect that very severe crash-like black hole declines well along within a larger decline. Yes, you can get a kickoff with some negative periods, but the crashes happen at the end of a move. So if we're at the beginning of a move, or maybe not quite at the beginning of a larger scale move, it's inopportune to play for a crash unless there is a setup, and sometimes we will get a setup that happens where I can say, look, there's a trap door here, there's a potential for a very severe decline in the next week or 10 days. That could happen, but I don't specifically forecast that right here, right now.
One thing that I had mentioned in our report, just on a technical basis, was that the S&P seems to be following the 15-minute charts as far as with positive and negative divergences, and it makes things pretty difficult right now because we don't really have any reversal date that's scheduled, concrete date that it's going to do it, and sentiment's been kind of neutral overall. We've had some extremes to the downside, and we've had a couple extremes to the upside, but it hasn't really been going crazy. So when the market starts following a very short-term time frame, like the 15-minute charts, what happens is you get these big moves up and down, and traders get very frustrated because they're either reading somebody that's telling them that the market's going to crash, or reading somebody that's telling them that the market, the S&P is going to 3,000, and they're getting in and seeing it drop some 40 points in a couple days, and then when they get short, it's rallying 30 points. So when it follows these the short-term time frames, it makes things really, really choppy. And I try to look at 60-minute charts for swing trades, charts for the actual as far as the trend wise, and then I try to match them up with what Woody is saying and predicting, and from there we paint a pretty clear picture as far as what to expect in the market. And one thing we had said was don't really push the short side, because we saw some some pretty big bearish sentiment readings, and we had those divergences on the 15-minute chart as the S&P was entering a support zone. So you don't want to press the short side on that because you're only asking for trouble. And as you're witnessing today, the S&P reversed and is up 13 points. So Renee, I can't see the actual question. So is there any other ones?
There is one, and real quick, one person said that she can't get the 2-week trial on the sign up.
Oh, no? Okay. Tell them to hang on. Just tell them to try it and give me 2 minutes and then try it again. I'm not sure what happened on that. That's strange.
Or she can email you, right, Gary?
Okay.
It looks like she got it now. She just didn't have the coupon code at first.
Oh yeah, you have to put the coupon code in there. That's the way you get the special on that.
And
so
then
that's all the questions.
There's one more asking if you're aware of Stan Harley, and if so, how does your methodology compare to his long-term cycle theory?
Woody, you're going to answer that, but I'm pretty sure the answer is going to be it means nothing to him because it's Woody does his own work and doesn't really get information from anybody.
I don't know, Stan. Can you hear me?
Yep, I hear you.
Okay, I don't know Stan Hartley, but I don't use long-term cycle work because I can predict the market in the short term. So that's the most important thing in terms of getting in and out of trades, or even getting into bigger positions. So it's not my focus. Thank you.
Excellent. Is that it, Renee?
Yeah, it looks like that is all the questions that they have
all right, well,
right now.
I thank everybody for allowing us to talk. Sorry it was a little bit shorter than, it's only 5 minutes, so it wasn't that bad. But Renee, this was fantastic. I appreciate it, and hopefully we'll get invited back again.